Hello, everyone, and welcome. I'm Therese Bacon, lead of the Seminar Series program. We're so glad that you could join us this evening. These sessions are designed to give you practical, relatable financial education that helps you feel more confident in navigating your money. We have a wide range of presentations planned throughout the year. You can explore upcoming topics and register by visiting msufcu.org/events. Today's event is being recorded, and you'll be able to rewatch or share it by visiting youtube.com/msufcu and selecting the MSUFCU Seminar Series playlist. If you have any questions that arise throughout the presentation, go ahead and use the Q&A feature at the bottom of your Zoom screen to submit those, and then we'll go ahead and address those once the presentation concludes. And if you run into any technology issues or anything like that, you can go ahead and directly chat me, and I'll try to help you through that. So tonight's session focuses on preparing for home ownership and understanding the full financial picture that comes along with that. Buying a home involves more than just a monthly mortgage payment, right? From those upfront application costs to the ongoing expenses after move-in. Whether you're just starting to think about buying or actively preparing already, this session is designed to help you better understand the process, what to expect, and how to plan ahead with confidence. So with that, I'm happy to introduce our presenter, Dawn Watson, Partner Experience Manager with GreenPath Financial Wellness. Dawn works closely with individuals and organizations to provide practical, judgment-free guidance around financial decision-making. She brings a clear, supportive approach and will help walk us through these things to consider as you prepare for home ownership. Dawn, thanks again for joining us. I'll go ahead and turn it over to you.
Great, thank you. So I appreciate everyone joining us today to talk about this exceptionally important topic. So as was mentioned, please put the chats in. I'm excited to talk with you about this. And for our agenda today, we're going to discuss, excuse me, preparing to purchase, financing your home, finding your home, and preparing for an emergency once you own the home. So before making a large purchase like a home, it's really essential that you prepare financially to make sure what you're buying will be affordable. So the first step in preparing to buy a home is really reviewing that budget. Instead of creating a budget based on what you think you should be spending, I highly encourage and recommend you actually gather your statements, your bank statements, your credit card statements, and determine what you are truly spending, especially when it comes to things that can vary significantly month to month, like groceries, gas, and discretionary items like clothing and entertainment. You're also going to want to make sure that you're looking at your pay stub so you can create a budget based on what you receive in pay after taxes and insurance and other deductions. Now, when the mortgage, when you're applying for that mortgage, they're going to be looking at your gross, but we want to make sure that for budgeting purposes that we're truly looking at your take-home pay. So to make this process hopefully a little easier for you, we'd like to share a budgeting worksheet. You can use the QR code that is on the slide, or we're going to throw that into the chat and you can grab that. We have both a fillable budget that you can download, or you can download a PDF and print it so that you can use it that way. So now that you know what you're spending your money on, when you're going to receive it, you're going to be able to create that budget to really look at opportunities to help you prepare for that home purchase. So let's just say that you're spending $300 a month on dining out, and you are thinking, I want to be able to try to get prepared for this home purchase. I'm going to be able to look at opportunities to maybe lower that amount to say $100 a month, and that $200 can go into your savings. Either to pay off debts in preparation for homeownership, down payment for that preparation, or just an overall emergency fund. So doing this exercise is so important because it is really going to give you a better sense of where you're spending your money. And I assure you, everybody does spend money that they haven't really thought about when you really get down into the nitty-gritties of it. So now that you have your budget, that's great. But the next step is really to track that spending. It isn't going to do you any good to know where you think you're spending it if you don't actually follow it, and tracking it is going to help you do that. So if you are repaid every 2 weeks on a biweekly basis, maybe it might be easier to actually track it every 2 weeks, go through, tally it up, see where you're at. Do not give up on budgeting or tracking your spending if it seems overwhelming, because it is. I cannot deny that. Habits can take a while to form, and budgeting is a new habit that you'll need to get used to. Don't think just because you spent more on a particular item than you anticipated in a week that it is just like throw it out the door. I'm not going to do it anymore. That is by no means what we want you to do. Just assume, okay, I made this change. I'm going to do something different for the next month, and I'm going to hopefully get back on track. Be patient with yourself. And if you have a family, a financial partner, somebody that you're going to be doing this with, make sure that they're included in this process. Make sure that you both are on the same page, working towards the same goals. And again, we're assuming that's purchasing a home, because if you aren't working towards the same goals or following the same process, you're likely going to get frustrated because one person's going to be doing something that the other doesn't realize. So again, communication is key here. Although each budget is unique, here are a few rough guidelines on average ideas of what your income might be or could be going towards. So housing, generally, they recommend 35% of your overall budget to be used to cover those expenditures. So it's not just the mortgage payments, not just the principal and your interest payment. It's also taxes, homeowners insurance. If you have an HOA fee, it should fall into that bucket. Your utilities, maintenance and upkeep for that home. So there's a lot of things that you have to project, give your best guess and what those things are going to be. But again, ultimately, 35% should go towards housing. Now, if your budget does exceed that, or what you're going to spend exceeds that 35%, you could consider looking at decreasing expenses in other categories. For example, maybe you don't have any debts and the projected spending guidelines say 15% for debt repayments. Great. That money could be reallocated maybe into your housing. Bearing in mind, though, it's important that you don't start accumulating debts and have no capacity to support them in your spending plan. Also, on some of those living expenses, they recommend 25%. Maybe you have some things that you can change and adjust out of that category to free up more money. Ultimately, this is your budget, your goals that you're working towards, and you can tweak those spending guidelines to make sure that you're being able to meet what you're wanting to meet, but within the overall, you're not spending more than what you're earning. So now let's focus on kind of that savings component. So the down payment is usually what most people think of as savings required to purchase a home. That down payment can vary. An FHA product, you might be able to get in for 3.5%. If you want to go with a conventional product where you're not going to have to pay what they call private mortgage insurance, which is ensuring the lender, if you defaulted on that loan, that they're not going to lose money on it. You typically would have to come up with 20% down to be able to do that. That's not saying you have to put 20% down, but you're going to have this added expense put into your mortgage payment, which could, again, impact your ability to afford what you're wanting to purchase. So also don't be afraid to contact a lender if you think that putting less than 10% down on a home is going to be a problem. Again, there are products out there that you can do. If you're a veteran, you could get into a home with zero down if you wanted to. You would just be financing the entire purchase. So just to kind of give you some ideas, let's say you're going to put 20% down. That's one of the goals. If you're thinking that you want to try to do that and you're purchasing a $200,000 home, I know that's probably not the average home price nowadays, but it's a nice, easy number. You're going to need $40,000 to be able to do that. But if you only did it with a 3.5% down payment, now you're at 7%, which for a lot of people is a whole lot easier to save for when it's purchasing their first home. You could potentially use gifts to cover some of that down payment. So if you have a family member or somebody close that wants to gift you money to make that purchase, you definitely could look into that. Most lenders, though, are going to require that the gifter is going to sign the gift letter saying that they do not expect that money back. So it's important that you understand those requirements because they're going to want to know where that money is coming from if there isn't a clear trail that you've been saving it over time, and they're going to require that. So you don't want to have your process of closing being delayed because you don't have the document that they're looking for. So let's talk about closing costs. So another aspect of financing a home besides the actual purchase price is closing costs. They can range from 2 to 5% of the loan amount. So once you've saved for your deposit, you might want to continue saving to cover these expenditures. These closing costs are going to include like your origination fee, the appraisal fee, title work, escrow fees, taxes and insurance upfront monies that have to be deposited into those accounts, possibly some inspection costs. And then, as I mentioned earlier, if needed, if you're going to be required to pay private mortgage insurance, there might be some of that included into those closing costs. Sometimes you can finance these into the home purchase. However, again, that's going to impact the amount of the payment, and you're going to be paying interest on these fees while you hold that loan. So ideally, if you can continue to save beyond the down payment to cover these costs, that would be the best. Now, generally, we recommend trying to have about 3 months of living expenses in an emergency fund, just in case there's loss of income, an emergency, a medical issue where you can't work and you're not getting paid. And this is important so that you don't have to fall back on credit if these things do happen. So during the home buying process, though, I've seen it many a times, people will turn to their emergency savings to put towards their down payment or their closing costs. And now they don't have that emergency fund to fall back on. If you have to do that, just make sure that you have a plan in place to replenish that emergency fund as soon as you possibly can. If your budget doesn't support replenishing it, be aware that you could end up then incurring additional credit debt that you don't want to try to cover an unexpected expense. So maybe delaying the purchase of the home a little bit so that you can replenish those funds or not use the emergency funds could be a good way to set yourself up for success. Also, there's other expenses that a lot of people don't take into consideration, such as those moving costs and appliance costs. And it's, not uncommon that you're going to spend money. If you have a great family and friend network, maybe they're willing to pitch in and help you make that move. If not, you're going to have to hire somebody likely, and you're going to spend money to be able to do that. In addition, be very aware of the appliances that are in there so that when you're doing this purchase, whatever's in the purchase agreement is what's going to be the case. So make sure that the appliances are intended to stay in the home if it's a currently occupied property and that they're not going to be taken out when you purchase it. So you might, think about your washer and dryer. Sometimes people will not include them in the home price in selling of it. And then you would have to purchase those or visit a laundromat to be able to manage those expenses. Also, if you're purchasing a new build, in many cases, they don't come with appliances. So you would need to have a plan and a savings opportunity to save for those so that you can have appliances when you move into your home. And of course, home updates. We all, have our own styles, our own personalities, and, you're going to have some wants that you're going to want to put into this very first home. You may want to paint all of the rooms. You definitely are going to probably want to change the locks on the home. You might want to purchase some new furniture. I mean, a lot of these are wants. They're not necessarily needs, but they're all expenditures that need to come from somewhere if you plan to move forward with those when you first purchase and before you actually move in. So having sufficient savings for each of these categories can really set yourself up for success again. So now that you're thinking about how am I going to be able to save and making sure that you have your budget so that you know what you can do, there's other components. And another area that you're going to want to think about is preparing for your credit, making sure that you are in a good position credit-wise to get the best possible interest rate that you can receive. So the first step, review your credit report. There are 3 major credit bureaus that collect information on all of us. And they generate the credit report. So there's TransUnion, Equifax, and Experian. So when it comes to apply for credit, different financial institutions might review different credit reports. You never really know what particular bureau they're going to apply for. In many cases, though, when it comes to a mortgage, the lender is going to review all 3 of those credit bureaus. They're going to do a merged report of all 3 of the data. to have a 100% clear picture of what things look like. And this is important to be really on top of the credit reporting with all three of these credit bureaus before you actually go to purchase, because a credit score could mean an interest rate adjustment, and that could mean a higher payment on your mortgage payment. Some creditors also don't report information to all three of those credit bureaus. So you might think, oh, I looked at Experian, we're good. And then you find out there was something that got reported to Equifax that you weren't even aware of. So that's why you're going to want to make sure you are looking at all three of those before you are ready to apply. Preferably a few months. So if you have to dispute things or take care of things, that you have time to get that handled and get that updated on the credit report before your application is actually done. So you're wondering, okay, how do I do that? So the recommended place to get your credit report is annualcreditreport.com. It is the website that was set up as a result of the Fair Credit Reporting Act, and it states that you're entitled to receive, the Act states that you're entitled to receive a free copy of your credit report from each of the three credit bureaus once a year. However, currently the three credit agencies, all three of them, Equifax, Experian, and TransUnion, have permanently extended a program that lets you check your credit report from each of the agencies on a weekly basis for free. So as you're starting to work on these things, you don't have to worry about paying for somebody to pull a credit report because you've already pulled your annual credit report.com ones. You can actually just go back here and do it again. So when you go to the website, just be very aware that you see the logo that's there on the screen, the annual credit report in the blue and red. Make sure you're in the right place, because there are a lot of sites that have very, very similar names that you could be putting your information into. There's possibly imposter sites as well. You want to make sure that you're putting it into the right place, that you're not paying for this, and that you're not going to be solicited from a lot of places trying to give you credit. So again, I would definitely recommend that you do this before you're ready to apply. I also recommend you do it using some type of laptop or desktop, because then you can save that report so it's easily accessible when you're going back to it and looking at things, tasks that you have set for yourself in ways that you want to work on, maybe some changes. So if you prefer and you don't want to do it online, there is a form that you can use to request your report by mail. That form can be found at the annualcreditreport.com site, or you can call the 877-322-8228 number, and they can send you a copy of that form. And I believe that got put in the chat. So if you want to grab that, if you prefer not to do it online, I've done it online many, many a times through annualcreditreport.com. I've had no issues. So if you're worried about that, just as long as you make sure you're in the right place, that's the key right there. So now that you got your report, review it for any negative or what they might call a derogatory item. So you can definitely, if you're concerned about doing that, you're not even really sure what you're looking at or how to read it, you're more than welcome to reach out to GreenPath, and we would be happy to review that with you. There's no cost for us to do that, to help you organize what's on that credit report, help you organize how to prioritize certain things to get that movement in the credit score that you might be looking for. So if you do have any red flags, you're going to want to start focusing on these collection accounts that you might have on there that need to be paid. Some are going to be more important than others. Medical debt, there's some new rules on how things get reported to the credit bureau. So you may not see as many of those. And there's rules on how they have to be removed from the credit report. But it's good to, again, focus on the collections, especially if they're related to credit cards, other secured type loans in the past. Those are going to be your first priorities. But we're happy to walk through it with you as well. Next is if you're carrying a lot of debt, a lot of unsecured credit card debt, that's another thing to consider, because the higher your debt balances are in relation to your credit limit, that can impact your overall credit score. It's called your debt to income ratio as well, is going to play a factor. So the more debt you're carrying, the lower the payment that they're going to allow you to be able to afford, meaning the lower the housing price that you're going to be able to get. So I would recommend, if you do have a lot of credit debt, work a plan to find a pathway to get that paid down before you apply, especially if you're really tight on your spending plan, because that's going to help. And again, that's something that GreenPath would be happy to kind of help you figure out what that path might look like to try to resolve some of that credit debt. Don't forget your student loans. Your financial institution will take a certain percentage of your student loan balance to calculate a payment for that debt to income ratio if you're not in a repayment plan already. So if you're in a forbearance or a deferment, they're still going to factor that in because the assumption is eventually you're going to have those payments. If you haven't communicated with your student loans recently, I highly encourage you to make sure that you understand what the status is. Are you in deferment or forbearance? You might think you are and you are not, and that could be impacting your credit. So you'll want to make sure you go to like studentaid.gov, figure out who your information about your loans, and then contact the servicer to have a conversation if you're unaware of where you're at. If you do find inaccurate information on your credit report, you do have the right to file a dispute. So first, you're going to want to dispute the item directly with the creditor, the collection agency, whoever is filing the report to the credit bureau. So you're going to want to file a dispute with them to see if they'll just automatically remove it because there was an inaccuracy. And especially like if you're a junior or senior, you may have things that don't belong to you. It might belong to your son or your parent. So you want to make sure that you file those disputes right away. If that doesn't resolve the issue, so if it was a debt that you said, I don't owe this, I already paid it, and they're claiming you didn't, and they're still saying that you owe it, you can also file a dispute directly with the credit bureaus so that they can investigate your claim. The more information you have available to support your dispute, the easier and the faster it's going to happen. But typically, you're going to want to allow 30 to 45 days for the credit bureaus to complete their investigation. And then again, make sure that you have all of your documentation, you retain copies, you submit those copies to them. So that's why it's so important to keep tabs on what those credit reports look like. So you're not doing it like right before you're ready to apply, because if you find something that needs to be addressed, it could take you a bit to get it dealt with. So let's kind of turn now to financing your new home. So we recommend getting a pre-approval letter from a lender before reaching out to a real estate agent. This way, if you find the home that you love, it's just a whole lot easier to make that offer as quickly as possible, especially if you're competing with other people. And a lot of agents are going to want that as well, because it's going to help them understand the price point of what homes you can afford within that approval letter. So, of course, you're going to need to find your lender. I would recommend, reaching out to MSUFCU to have this conversation. If you've not had a relationship with anybody in that area, they're great. They'll help you, walk you through it. So don't hesitate to reach out to them. If you do have a family or friend, somebody that has recently done a home purchase, it might be worth asking them for some referrals as well, so that you're making sure that you're not getting into a position that you don't want to be in with somebody that's not looking out for your best interest. So there's a lot of information that they're going to need to prepare you for this pre-approval process, because essentially what they're providing you is a formal commitment from the lender to give you a loan up to whatever the amount is. Usually there is a set time frame for that pre-commitment letter, 60 to 90 days. So if you don't find the home that you're looking for, you may have to go through the process again. Keep in mind, there could potentially be a fee for that pre-approval process. And you still will have to qualify at the time of purchase. So if you get your pre-approval letter and you're like, okay, I'm great, and now I'm going to go out and buy all these new things on credit, and they're going to look at your credit, you could lose the ability to get into that home because of those decisions. So the lender is really working to get you pre-approved, meaning that they're committing to lend to you at a certain money amount based on the income, expenses, and credit that you've provided to them. So assuming that they all stay the same, then that would be something that when you go to actually apply, they would be able to do that. So again, check with the credit union as far as what their pre-approval process takes. I believe in the past it was somewhere around 1 to 3 business days, but that could have easily changed. So you may also be asked for proof of assets if you intend into dipping into things like retirement to cover some type of expense, or they want to know if the money that you're saving isn't within the financial institution that you're applying for your loan with. They're going to want to know where that money is coming from. Again, you can't borrow the money from a lender to pay your down payment on your house or the closing costs. They're going to want to know that this is your money that you're bringing in. The lender will most likely also do that credit report pull at that time to give a list of those debts, like car loans, large, credit cards, any of those monthly obligations that you're paying out. So that can be part of how much they're going to lend to you. And in certain circumstances, you may be required to provide a few other documents. So we've already mentioned earlier that gift letter for the down payment. The lender may also ask for letters explaining things that are on your credit report. They may ask for divorce papers, child support orders, if you're using that in the process. Again, it really depends on what you're using. I know this years ago, we had to provide a letter because my husband had co-signed an obligation for his sibling, and they wanted us to prove that he had made those payments for the last 12 months, that it wasn't coming out of our account before we could get our first mortgage. So, there's some odd requests and things that might come up. So just be prepared to be able to provide those. So earlier, we briefly mentioned like debt to income ratio. Now is a good time to really cover this topic. So in the home buying process, you'll probably hear people talk about qualifying ratios, debt to income ratios. These ratios are used by underwriters to determine if the potential mortgage amount will be affordable for you individually. If your current ratios are higher than the allowable maximums of the lender, you'll either need to increase your income, decrease your debt load, or purchase a less expensive home. So there are a couple different ratios. So you have your front end ratio, and that is going to compare your gross. So again, they're looking at gross monthly income against your mortgage payment, including taxes and insurance and your HOA fees. So the ratios can vary depending on the lender and the type of mortgage that you're applying for. Typically, a front end ratio is somewhere between 28 and 31% of your gross monthly income. And then there's also a back end ratio. So the back end ratio takes all of your debt payments, including those future mortgage payment obligation, into consideration. So they calculate by dividing all of those monthly payments by your gross income. And the back end ratio is usually around 36% of that income. Some lenders may be able to go a little bit higher than that. Some products might be able to go that. So again, you'll want to check with the individual lender what their ratios are, so you can kind of get an idea before you spend the time getting your pre-approval letter or applying and spending the cost to do that, to see if you are in their range. Now, keep in mind that ratios are one thing that the bank will use to determine what they will lend you, but it's important to recognize that they don't take into consideration everything that you might be spending your money on. And I think this is key for a lot of people, because if you're paying childcare expenses, which can be a hefty portion of one's budget, that isn't factored into that ratio. So they might say that you can afford to buy a house based on the ratios of X, but that payment might be way more than you can comfortably afford when you factor in expenditures that you have to have or are important to you that aren't showing up on your credit report. So don't forget some of those things. Just because you're told that, yeah, your ratios tell us you can afford this big of a payment, don't assume that that's what you need to spend. So let's talk a little bit about the different types of mortgage products that are out there. So a conventional loan, it's essentially a mortgage that is not insured or guaranteed by the government. It's held by private investors, commercial lenders. Again, this is why they typically require a higher down payment, is because there's going to be greater risk if you're going into this with little or no down payment at all. And if the market changes and you can't afford the payment on the house. So then you have your FHA, USDA, VA. These are all government-backed loans. This means that the federal government insures the loan, protecting the lender in the event that a borrower is unable to repay the loan. The federal government implements specific guidelines that mortgage companies have to follow when securing one of these loans. So like I said earlier, like the FHA loan is going to require only a 3.5% down payment because the government is backing it with the lender. However, there might be additional home inspections that you cannot waive that are going to be part of that home purchase cost that you might have not ever considered. USDA and VA may have loan products where you aren't going to have to pay any down payment at all. But these type of loans do have specific requirements for qualifying for them. So of course you have to be a veteran, spouse of a veteran. USDA, it's location of the property, it's rural development. It's looking at rural homes. You can't buy a house in a city typically when you're doing a USDA type back loan. Also, there's other guidelines. It's a very unique product, so I would recommend definitely investigating that one before you move forward with it. And then, of course, I'm sure you're all aware, interest rates are constantly fluctuating. They're higher than they were back 4 years ago. But that is going to have an impact. So the higher the interest rate, the more you're going to be paying in interest, and the higher the payment's going to be on your mortgage. So, be aware, interest rates do fluctuate a lot, but once you lock in that rate for a lot of products, it's going to be a fixed rate mortgage interest rate. You're going to be having that same payment unless you were to refinance at a later point in time. So also keep in mind, what inventory levels look like when you're kind of going out to start hunting for a home. If it's a seller's market, they're probably not going to negotiate as much on the purchase price as they might have otherwise. You might be paying top tier prices for some of those homes. So it's important to keep that in mind as well. So let's kind of talk about finding that perfect home. This is what's fun about the home purchase part. So I would start by, looking for a realtor, a real estate agent that is in the area that you want to purchase. It's important that they know the area because they're going to help be able to guide on some of this. So if you have a family member, friend, somebody that's used an agent recently, that might be a great place to get a referral to get connected to somebody. You could also search online to find a real estate agent in your area. You can, when I searched for real estate agents, I found that looking for someone who had experience in that home area was important, but also understanding what they've previously done. You can kind of look at their website, kind of understand, what they're selling, who they're, if there's a particular, how many houses they've sold, that might be important to how much experience that they have. So keep that in mind as well. Next, you're going to want to figure out where you want to live, which, for everybody, that's going to be different. Some people are going to need a certain size of home. Maybe you have a larger family size and you want to make sure everybody has their own individual bedrooms. So that's an important part of what matters to you. Maybe there's certain bathroom numbers that you want to make sure that you have in the home. Some people want small properties. I know my daughter, she's like, I am not buying a house that has a lot of land because I do not want to have to take care of it. Where I live, I have 10 acres. So there's a lot of lawn maintenance. So it's important to understand what you're willing to commit for that. Also, does a garage matter or not matter to you? Do you care about an HOA? I know that some people would never purchase if they had to move into a neighborhood that have an HOA. They would look somewhere else. Make sure you know and have vetted the school systems if you have children or expect you're going to have children, and the schools are going to matter because you want to know what you're going to be sending your kids to at a future point. And also think about the longevity into this home. If 1 story, 2 story, what you're looking at, if this is your permanent home, that's going to be important. Are you going to want to be climbing stairs to go up to the bedrooms? Or if your washer and dryer in the basement, you have to walk downstairs to do that and then haul it up to the upper floor. So it's really important to kind of think about, how long you want to be here. What are the needs now? What are the needs going to be in the future for that particular home? So a couple other important things to consider when you're looking for your home is, is it important for you to have a home that's move-in ready? Or are you willing to put in some sweat equity to make it just that perfect home? Because if you have the skill set and the money to be able to invest back into that property, you might be able to get a home cheaper as far as the mortgage is concerned, if you're willing to do that. Also, what about your commute? Do you care? Do you work from home? Maybe it doesn't matter. I live very rural. I didn't really think about my commute. And it takes me almost 15 minutes to get to a true grocery store from where I live. There's no, I forgot to get a gallon of milk, I need to just go grab it. A little bit better now with the DGs around in the world, but still, think about how this matters or doesn't matter to you, and where you're going to be looking for your home. Now, once you found the home of your dreams, your real estate agent and the mortgage company, they're going to work together to guide you through the rest of the purchase process. Your real estate agent will help you write up an offer letter that hopefully will be competitive, that will give the seller the ability to look at what you're offering and hopefully accept that offer. You will have about 7 days to get a home inspection done once that offer has been accepted, to ensure that you know what you're getting yourself into. I wouldn't recommend foregoing your home inspection unless you have somebody close to you, family, friends, that can do it for you. You're still going to need to ask for the inspection, but I wouldn't not pay for one unless you have somebody in your life that is super capable of that, because you never know what you're going to find that isn't easily seen to the naked eye. So I would definitely recommend it. Next, your lender is going to order an appraisal. This is done to make sure that the home is actually worth what you agreed to pay for it. So it is going to basically, if it comes back and says, yep, it meets the purchase price of what you offered to purchase it for, then you're good. If they say the house did not appraise for as much, then you have some decisions to make. Either you need to get the seller to reduce that purchase price so that it can fall within the appraisal numbers, or you need to come up with additional money to cover that difference beyond the traditional mortgage payment, because you're going to need to finance less money, but the seller is still going to expect what you offered if you continue forward. So it's important that you think about that. And don't feel like you can't walk away if they're not going to negotiate with you. I know that it's hard sometimes when you got your heart set on something, but don't put yourself in a financial position that's going to be challenging because of emotional attachment that you have started to have for that home. And of course, you're also going to need to provide homeowners insurance for the home. So you're going to need to have proof of that insurance prior to closing. So you're going to want to make sure that you have taken care of that you have your declaration that you can provide to the lender at the closing or prior to the closing even, to show that you've had that. So that's another important part of this. There's other few things you're going to want to think about, moving the utilities in your name. Are you going to have to pay fees to the utility companies to do that? So other little minute expenditures that you might have beyond those things that we've already talked about. So buying a home can be one of the most exciting times in your life. For most people, it's probably one of the biggest single investments that you're going to make. But now it's time to talk about the opposite end of the spectrum, and that is what happens when you hit a bump in the homeownership road. These bumps in life are inevitable, but how you handle them will make all the difference in successful homeownership. So we're going to talk first about things you can do to prepare for an emergency, and then talk about things and options to handle it if the emergency does occur. So one of the keys, as we talked about earlier, is having some emergency funds at hand so that you can cover those unexpected expenses, or a temporary loss of income So it's important to do that. And I'll tell you, these things happen. I was probably in my first home that my husband and I purchased, again, many, many, many years ago. We had two small kids, and we live out in the country, and we have a septic system. We don't, a septic and well, we don't have sewer and water with the city. And our septic system failed. We had the home inspected. They didn't come up with knowing that that was happening. We had to invest thousands of dollars into replacing our septic field, which was luckily something we could handle, but not something that we expected or wanted to. So again, don't assume that if even if it was inspected, that something might not happen. Don't assume that if it's a brand new house, if the warranty has expired, that you still might not have issues, because they can happen. So the goal should be to try to put 10% of your income into savings every month. However, if that's not possible, something is better than nothing. Do what your budget can support. Just make it a priority to do something. Having access to 3 months of living expenses will set you up for handling an emergency, of course, and making sure you can access funds quickly so that you don't have to rely on other sources. I know a lot of people that I've seen and talked to have used their retirement monies. They've taken loans against their 401ks to handle some of these emergencies because they didn't have money already set aside. So again, it's important just to really think about how am I going to factor this into the whole home buying process by, not only your down payment, your closing costs, all of those extra things you want to buy, but also this emergency fund. In addition to setting aside an amount each payday, consider using your raises or your tax refunds, or if you get any bonuses to boost that savings. So if you can't do the 10%, but you can do a small amount, use these other ways to try to build that savings up faster and faster than you might have otherwise been able to do it. Now, reducing your other debt is also key to getting ready for an unexpected event. You may have heard of the snowball method to pay off credit card debt faster. So again, you start, what it is, if you haven't heard of it, is you start with the lowest balance account, making sure monthly payments are paid to every creditor while you're doing it. And then once that debt pays off, that money plus the normal payment you were giving to them rolls down the snowball. It rolls into the next creditor, into the next creditor. So whatever the amount is that you're paying to credit debt stays stable and allows you to get it paid off faster instead of just making those monthly minimum payments. Also, keep your balances from growing too large in the first place. Really avoid charging non-essentials. Don't use your credit cards to take a vacation. Don't use it to go and buy the extra things for the house that maybe you didn't really need. Really think about how you're being influenced maybe to spend money, and try to avoid those impulse purchases so that if there is something that you need that isn't a necessity, that again, it's part of that goal setting and that you're able to save and use that for it. So plan ahead in your budget for things like holidays and vacations so you don't have to use credit cards for those. Birthdays and anniversaries are always going to be the same time of the year. So you can plan accordingly if you want to celebrate those, but also take into consideration the extra things that you might want to do. Again, little mini vacations, gifts that you want to purchase for special occasions that don't come up frequently, the special night out with your financial partner. Use some savings and planning ahead. We call them sinking funds. So you're going to put money into that and earmark it for these particular categories so that when they come up, you have that money to pull out and do them. You could also, if you do have a lot of unsecured debt, you could also explore a consolidation loan that might provide you with a better interest rate so that more of the payment is being applied to the debt balance, allowing you to pay it off much faster. Just make sure that if you do consolidate debt, that you are not continuing to use the credit cards, because the last thing you want is to have a loan payment and now credit card balances again. We also here at GreenPath provide what's called the debt management program. So with help with a certified nonprofit financial counselor, we could help look at your debt situation and determine if you could receive benefits of lower interest rates, lower monthly payments, if needed, to try to get these debts paid before you actually purchase the home, and so that you can prepare if there's an emergency when that happens. So if this is a situation where you're like, yeah, I really probably should get this debt handled, definitely don't hesitate to reach out to us so that we can help you through that process to look at all of your options, whether it's the snowball method, whether it's a loan, whether it's whatever that was right for you. We can talk the pros and cons out with those various options. Another thing to help you prepare for an emergency is having a home maintenance fund. Again, this should be separate from your emergency fund if possible. 1 to 3% of your home purchase price is ideal for a maintenance fund. Things are going to happen. Again, there's no way you're going to buy a house and not have to invest money into that house. Depending on how old it is, the more likely it's going to happen. So again, you could put this as a separate category to offset those expenditures. Also, I highly encourage you to create a maintenance schedule for your home. Think about replacing your furnace filters on a timely basis, making sure that you're inspecting things and ensuring that you're not having any issues. Because if you can catch them before they become a big problem, it's going to be less expensive than having to replace your whole furnace. So definitely think about that maintenance plan. So also another way to cover costs of maintenance are through warranties. This could include home warranty, which also home appliance warranties that you might be able to get through the utility company. A lot of times, sellers may even offer a home warranty to kind of sweeten that deal when you're negotiating that home purchase. So you can decide if this is important for you. Just make sure that you understand what the warranty covers. If there is like a deductible or something that you have to pay, is it replacement or is it a percentage of the value based on the age of whatever it is that they're replacing? Really understand the content of what it's going to do for you before you pay for one, or before you assume that it's going to cover all of your needs if you do have a warranty on the property. So I know we covered a lot of information, but keep in mind, as I have already said a few times, GreenPath is here to support you on this journey. We can, as I said, help you review those credit reports. We do provide home buyer education. So if you want somebody to kind of walk through it with you, we can provide that for you. That might help if you're getting a mortgage product that requires education. Because we are a HUD certified agency, it can cover that requirement. It could also cover some down payment assistance programs that exist out there, but you'd absolutely want to make sure that you talk to them to confirm what we're doing meets that requirement. If you have student loans that you just haven't addressed yet, we can talk about those. And then, of course, help you create a plan to manage your debt. In addition, we do have an online digital course. So if you want just to kind of review this again, you can go to our Learning Lab Plus on our website, and the QR code, you can use that. So if you go to greenpath.com/MSUFCU, you can access this course. It's a 5-part series. So it's just another great way just to kind of reinforce some of the things that we went over in this conversation. And then you can also give us a call and we would be happy to kind of walk you through that as well. So you can use the 800-747-2898 number. That is a dedicated number specifically for MSU FCU, but we also have our general phone number that you see on the screen there. So I hope that it answered some lingering questions that everybody had. And we'll take a look at the chat, the Q&A there for some questions that might have popped up that you still are looking for information for.
Yes, thank you so much. We did have a couple questions come through that kind of were more like lender specific. So I just answered those in the chat so everyone could probably see those. But one was about unfreezing credit. So yeah, that's really something that you'd want to talk to your lender about. But usually it's only, a short window. Usually when you apply, credits automatically being pulled right then, or within 24 to 48 hours. So, but definitely best to ask your lender if you do need to unfreeze your credit. And then the other question that came through was someone that lives in Illinois, and they were asking about MSUFCU mortgages out of state. And yes, we do. We cover mortgages in Michigan, Alabama, Arizona, Colorado, Florida, Georgia, Illinois, Indiana, Kentucky, Minnesota, Missouri, North Carolina, Ohio, Oregon, Pennsylvania, South Carolina, Tennessee, Virginia, Washington, and Wisconsin. So I just wanted to say all of those so that everyone was aware. There's also a list on our website that you can check out for that. Let me see if there's any other questions that have come through. Yeah, I'm not seeing any other questions. I'll give everyone just a minute. And while I give everyone a minute, if you are still typing a question, that's fine. But I also wanted to plug our upcoming webinars. So let me pull out the list so I can tell y'all. We do have another virtual webinar coming up next Tuesday, May 12th. It's called Savings Made Simple with MSUFCU. So we'll just be talking about all of our savings products, explaining how different savings accounts work and things like that. So definitely check that out. That's another 6 p.m. webinar. And then also I wanted to highlight our new lunch and learns that we're doing. So we have a lunch seminar where we actually feed you at our headquarters building in East Lansing, usually about once a month. So the next one will be on Wednesday, May 27th at noon. And that's going to be focusing on navigating trust accounts with MSUFCU. So, estate planning, everyone, this is something that, probably a lot of people put off and that type of thing. So we'll just be talking about how, how we can help make the trust account process a lot smoother. We'll have our manager from that department here to answer any questions during that lunch and learn as well. So you can register for all those at msufcu.org/events. In the meantime, still haven't gotten any questions, so I guess we can wrap up. Dawn, I really thank you so much for joining us again.
Yeah, thank you for having me.
Yeah, GreenPath is just such a great partner of MSUFCU. We refer people over to them all the time, and you guys just provide such great support. We get such great feedback from our membership that does work with you. So thank you all for that.
Great. Thanks, everyone.
All right. Have a good night, everyone. Bye-bye.